Hello and welcome to today's webinar, sponsored by EastNets and moderated by Finextra Research. My name is Gary Wright, I'm the Head of Research at Finextra, and along with the panelists who I'll introduce you to in a short while, we're here to tackle today's discussion. And that is global trade-based financial crime where trade and payments meet. And I'll come back to that topic in a short while. One of the most important things when we host these webinars is your contribution. And through the link provided, if at any time during the session you have a question, you have a comment, you have a remark to make, please share it with us and we'll try and bring that into the discussion. We want this to be very interactive. It's a huge topic and we're going to try and tackle it from many different angles. There is a report actually that you might wish to download. I suggest that you have a look at it and do so. It's a summary of a survey we did extensively over the summer with EastNets here at Finextra, Global Fight Against Trade-Based Financial Crime, and it really is a very insightful look at the level, the alarming level in which financial institutions around the world are perhaps not best prepared to face the growing threat of sophisticated trade-based financial crime. So do take a look at that. The session takes two parts, really. The first is I'll introduce the panelists, then I'll ask each of them in turn to set the scene with some contextual background from their perspective on the whole subject. And then after that, we'll have the opportunity to go into a deeper, more considered conversation during which please ask questions and make remarks. So, global trade-based financial crime where trade and payments meet. I suppose we've got to look at this in the context of firstly, the level of growing financial crime, and we'll talk about some of the stats that emerged from the survey and the research paper. We've also got to look at the way that trade has evolved, or perhaps not in terms of the operational side of it, the very manual processes and procedures that still dominate the way that trade is facilitated. So we'll look at the level of trade-based financial crime. We'll look at how we are currently trying to detect and prevent it. We'll look at the measures around the risk and some examples of crime that we're seeing increasingly sophisticated, increasingly global in this very challenging geopolitical world in which we operate. And then we'll start to look at how we can address them. How is the best approach? What do we need to do individually and collectively? And what's the role of machine learning, artificial intelligence, Gen AI, or indeed technology as we start to prepare for how we better position ourselves to deal with the growth of trade and the growth of crime. So let me introduce and thank our speakers. First, we have Dea Inab, who is the Deputy CEO at EastNets. Welcome. We have Rob Kuiper, who is the Global Head of SPS within the Transaction Monitoring area of ING. We have James Neal, Senior Associate, a lawyer at HFW, and Andre Casterman, the founder of Casterman Advisory Board and a member of the ITFA and a great deal of experience in this business. So hopefully you'll agree we've got quite a spread of input to get through. So let's go for that first session. And Dea, let me ask you first to give some thoughts to this topic from your perspective. Dea.
Thank you, Gary. Thank you, everyone. Good morning, good afternoon, good evening, wherever you are, guys, listening, hearing us. Thank you for attending this webinar. I would like to start first saying that I'm not here today as a leader being in this position as Deputy CEO, but as someone who has witnessed the challenges in financial crime management from front lines. For years, we have focused on improving compliance, increasing automation, putting tight controls, yet still we faced a very sophisticated financial crime that are outpacing the efforts. And this is very frustrating, very disappointing. But when you ask yourself, why is this happening? From my experience and my opinion and our involvement with customers, we have noticed that financial institutions often reacting to risk rather than anticipating it. Many are still relying on outdated classic systems, continue to operate in silos and expecting different results, which is really insanity by definition. So the isolated and reactive mindset limits your ability and our ability to foresee the emerging threats for such complex risks. This approach is no longer effective even for non-trade related transactions. So you can imagine how ineffective it is to navigate or to mitigate a complex risk associated to trade-based financial crime. But we have also not to ignore the other face of trade finance. Trade finance isn't just a regulatory problem. It is a missed opportunity. What is happening that we are letting complexity and fear of non-compliance stop us from seizing a huge potential in trade finance. So from my experience, a real solution is not more barriers, more control. It is a matter of more integrated, more data-driven approach, more smarter solutions. And if you aim to lead in your industry, focusing on de-risking, avoiding risk will not really get you there. So I hope today you will not only explore the threats and how to navigate around it, but also to identify the massive opportunity that trade finance offers if you really equip yourself with the proper and needed tools and protection lines. So I hope this will be enjoyable and useful at the same time.
Dea, thank you very much indeed. And I think you touch on several things that we're going to talk about in more depth as the webinar moves forward. Not least of all, the somewhat fragmented way in which trade operations are undertaken in today's world. And I suppose it's also fair to say that really it's a world in which the fintechs have not really played too much. So it's incumbent on the banks to look again at their attitude, their technology, their mindset and approach to this whole topic. So thank you very much for those opening remarks. And Andre, I'll go to you for some thoughts. Andre, we can't hear you. Is he? Okay, while we try to get Andre back, let me just go to you, James, and see if I can work with Andre to get him back online. James.
Sure, of course, Gary. Thank you. So, I mean, Dea has picked up some of the real key themes here, and the reference you made earlier, Gary, to this increasingly insecure world that we're living in. The heightened state of geopolitics is really creating increased demand and opportunities for trade-based financial crime. We're seeing increased incentives for bad actors to try and operate in those higher margin markets, particularly as we've seen the sanctions landscape develop over the past 2 years. But we're also seeing with developments in technology, new opportunities, new methodologies, new typologies that are increasingly sophisticated and hard to detect. But that also runs parallel to the, in many respects, quite old-fashioned way in which international trade is conducted, whether it is hard copy paper documents, handwritten mates receipts, surveyor reports, and so on. All of which make managing this risk increasingly more difficult. And really what we're seeing is, I suppose, the regulators waking up to this gap in the kind of financial crime landscape. We've seen a lot of focus historically on the pure financial side, but increasingly the regulators and the UK government are pushing the compliance burden onto the private sector through increasingly complex and onerous legislation. And what that's resulting in is kind of, I suppose, a twofold risk, which serves as a brake, as Dea said, on trade finance opportunities. Firstly, to kind of respond to those substantive compliance risks, stopping financial trade from happening, but also trying to manage the financial sector's role as essentially a gameskeeper for the whole trade-based industry. And as we'll come on to discuss a bit later, I think there have been some new developments kind of over the past week that's just going to increase that administrative regulatory burden that sits alongside it.
So James, be keen to pick up on those points, and I'm always interested in the friction that emerges from processes that are somewhat stale dated, dare I say it. But how do we also, picking up on Dea's point about the opportunities, there are many good actors trying to do good things. Exactly. Trade is growing, it's global. So how do we sort of support that significant number of actors, but at the same time deal with the bad ones, and how do we get that balance right between the two? So yes, we'll come back to those points and about the complexity of regulation and the introduction of it on a global scale. So thank you for those remarks, James. Andre, your thoughts, please. Andre, we've still got a problem, so we'll work with him again. So Rob, may I come to you?
Yeah, of course. Can you hear me?
I can hear you, yes. All good.
Okay, very good, very good. Yeah, so the challenge that we have from a transaction monitoring perspective is it starts with the data. We of course look at the payments, we look at the underlying documentation that is provided, we put all the underlying trades in the system, and then we combine the trades with the payments. And from there we try to derive the bad actors from the good actors. And of course, like you indicated, there's more good actors than bad actors, and you want to pinpoint the ones that are really, really bad and take them out by means of having proper transaction monitoring in place. And with the rule-based systems that we used to have in the past, we were basically not capturing what we wanted to capture, and 99% of those led to a false positive. And now we are moving into the world of AI, we're moving into the world of machine learning models, we're moving into the world of advanced analytics, and now you can see that you're not only looking at your underlying client, but you're also starting to look at the network that your client is acting in. And on your underlying client, you perform a CDD, you perform underlying screening, but now that also the network of the client becomes visible with the advanced analytics that we have, and combining internal data that you have with the external data sources that are there, you become much more effective in your transaction monitoring.
So we'll certainly pick up on that. As I said, with the level of manual processing and documentation, then it's not so easy maybe to capture that data in the first instance as it might be in other industries. So how do we do that? And of course, how do we then start to label and tag this information to effective use, particularly if you're starting to look at the monitoring of the transactions on a global scale? So let's just push on. I did say that we had a poll question for you. So through the link provided, I'd really appreciate you responding to the survey question, and I'll read it out for you. It's, what's the biggest challenge your institution faces in detecting and preventing trade-based financial crime? There are 6 options for you. A lack of awareness or expertise. B, reliance on manual processes. C, difficulty implementing solutions. D, staying ahead of evolving threats. E, no clear and central ownership of trade-based financial crime, or is there something else? I'd be very interested to see those responses. So let's push on and get into a bit more detail now. Dea, let's just pick up on some of the things that you highlighted there and talk about what is the state of trade-based financial crime globally. We know the numbers are significant. We know it's growing. How would you summarize it, Dea?
Yes, Gary, this is very, I would say, very good question, because the answer is clear. I believe everyone acknowledged that the trade-based, the trade finance contributes largely in the financial crime. And this is acknowledged actually globally. So if you look at the research report that you have mentioned, 92% of financial institutions identify it as a critical issue, and that has a substantial global implications that we need to really pay attention. Also, in terms of the size or the quantifying this risk, it's really hard precisely due to the complex and the hidden nature of this crime. But it is believed that it contributes 20 to 30% of the global illicit funds that flow globally in different different trade channels. So it is recognized as one of the most complex and the least detected, and even FATF, they have highlighted this as the least understood, not only the least detected, it's the least understood and the most underreported financial crime globally. And we have to ask ourselves why it is that complex, why it is so hard to deal with such things. There are several aspects, but the two major aspects is the volume and the nature of these transactions. So if you want to really look at the volume, Gary, according to WTO, the combined estimated value of global trade is 32 trillion annually. And the total individual trade transaction is really hard to estimate, but with the hundreds of millions of shipments and financial transactions, the volume is really massive. SWIFT alone, they do 42 million financial transactions on a daily basis. Okay, not all of these transactions are trade related, but there is a significant portion involved trade finance and cross-border transactions. Additionally, the IMO, the International Maritime Organization, they said that more than 11 tons of goods were shipped globally in 2023. This involved hundreds of millions of individual shipments and associated financial transactions. And when you look at the trade finance, approximately 80% of the global trade has one kind or another of trade finance, some form of trade finance. So that means trade finance, they really facilitate approximately 25.6 trillion of global trade. This is huge, this is tremendous. So given also that most of trade transactions are backed with letter of credit, documentary collection, or open accounts, so the number of transactions related to trades is in hundreds of millions per year. So the volume itself, it's a huge complex. Adding another layer of complexity is the type of transaction being expanded across different jurisdictions and having the regulatory barriers. One of the biggest challenges is the lack of harmonization in trade regulation across countries. Different jurisdictions, they have different requirements, different compliance requirements. Add to it the thing that you have mentioned, Gary, that the fluidity of regulation caused by the geopolitical situation, it has a huge impact in trade flows. And trade finance is one of the I would say, that the heaviest practice really to adapt rapidly to the changing geopolitical landscape, because there's sanctions, there's trade wars, there's shifting in international alliances. All this is creating an ever-evolving environment, making it really hard for the financial institution to make sure that they are compliant all the time. The banks have to adjust to deal with sometimes a new jurisdiction that they are unfamiliar with, or in new systems, or in new countries that are under-regulated. All these are things that the bank has to continuously adapt and work with that. So naturally, with this volume and this complexity of information, a typical trade-based financial crime case, usually the investigator, they have to review thousands or sometimes tens of thousands of transactions and documents. As you said, I call it the archive room, not even the filing room. So to detect a certain transaction, you need to really look to thousands of transactions. I'll give you one example. In 2019, a US bank, they detected a schema involving 200 million of trade-based financial crime. But they only discovered that after checking and examining 30,000 transactions manually. 30,000 transactions. It took them 6 months to find this schema. Yes, trade-based financial crime schema involved hundreds of millions of dollars, but the problem is that it is hidden within hundreds of millions of legitimate transactions as well. So often they're using small discrepancies of false documentation across multiple jurisdictions, and that's why it's really very hard to detect. Sorry.
So Dea, no, that's excellent. I think the figures and statistics you've shared there are truly staggering and very revealing if you think about the volume of trade and the level of losses and so on. And I know we're going to talk about some of the complexity of regulation. We're going to talk about the monitoring of transactions, and we're going to talk about how we overcome these, as I say, stale dated processes. But let me go back then. And Andre, firstly, can you hear me?
Yes, I can hear you, Gary. Very good.
Excellent.
I hope
Right,
you can hear me this time. Yes.
I can indeed. I can indeed. So let's move on. What I would like to do, perhaps, is all of the things we've talked about have a huge dependency on the underlying very manual processes, and indeed the instruments themselves, which are not always electronically replicated in legal terms. Okay, so from the point of view, Andre, and you've seen this from quite close up. How are these manual processes going to be looked at and improved, and indeed even the fragmentation of trade business units across banks? How are we going to start to overcome the very basis of how these documents are handled and processed in the first instance before we move on to a conversation about how that helps us tackle fraud? Andre.
Yes, I mean, on my side, I'm representing here a banking association focusing exclusively on trade finance. This is the International Trade and Forfeiting Association. We have a fintech committee, and our members are the core membership are indeed the large trade banks, credit insurers, law firms, and have indeed identified and repeated over and over that financial crime compliance is and fraud is really the top priority. So we have been busy on recognizing that in order to increase digitization, because that's the key issue, is that there's a lack of digitization in some of those documents, take bills of lading, for instance, and the fraudsters are basically leveraging this lack of digitization to commit crime, and basically which has led to some level of bank de-risking. Large banks have really left that space, providing less liquidity to the market because of a few instances of huge fraud. I'm talking about top 5 banks here. I will not mention them. They are known. So we need to work on increasing digitization around those documents, those transactions. And we know that in order to achieve digitization, we need to align the market. It's not easy, but we also need to change the laws. So we've been busy at this since 5 years on the ITFA side, but some people at the level of the UN, United Nations, have been busy at this for 15 years and created a model law for negotiable instruments. And that include indeed the warehouse receipts, the bills of lading, and also other banking instruments like bills of exchange, prom notes. And the effort has paid off because actually the main legal system, which is the English law in global trade, has been upgraded last September with the Electronic Trade Documents Act, which basically allows the market to take advantage of the electronic bills of lading and electronic prom notes and bills of exchange in an interoperable way. So we're working with the market to demonstrate how those new technologies are enabling those documents to become digital. There have been solutions for 25 years in the market with bills of lading platforms, but they never scaled. So now we have basically the market quite aligned with different associations, not just us on the ITFA side, on the banking side, but also DCSA on the logistics side. This is a container shipping association, and BIMCO, which is the bulk freight association. And those carriers, members of those two associations, are committed to achieve digitization of at least transport documents, which is where much of the fraud happens in documentary trade. So we have seen over the last few years, definitely an alignment in the market, change of legal systems. And I just mentioned the English law, but also more recently, the French law got an upgrade. And the US will follow very soon. It's a matter of weeks now. And other key countries are following as well.
So, Andre, let me come on to James, because we'll talk about the regulatory complexity in a moment. But in addition to that, are you seeing financial institutions themselves get to grips with how to digitize these processes themselves? You've talked about the instruments, you've talked about the way this is panning out, but it still seems to me that operationally it's a hugely fragmented process with a large number of banks. And Dare, you may have a quick view on this first, but are you seeing the transformation, the modernization of this within the banks happening at the pace it needs to? Andre?
So it's still early days in terms of impact of those changes onto the market. But in the meantime, basically, what we have seen is that the banks have been upgrading their internal systems and continue to upgrade their internal systems with more monitoring and fraud prevention tools. And it's easier for a bank basically to start there in the back office, in the front office and middle office to upgrade, to gain more transparency, visibility, monitoring in real time of those transactions. And I've been working on this for a decade also on the payment side. So it's definitely being achieved on the trade side, to digitizing more and more the internal processes. But the real challenge for the industry is to digitize the communication, the exchange of information, the exchange of transactions, documents, transactions amongst banks, right, and between banks and their corporate clients and logistics providers and those different platforms. So the fragmentation is really in the exchange of information. Internally, things within banks, I think things have improved a lot because a lot of providers are providing now those solutions to increase the visibility, the transparency, and the monitoring in real time of those transactions.
Okay, but it's good to see that that is actually happening. Dare, a quick word on that before I move across and push on to some of the other issues we want to tackle. Are you seeing this transformational change happening with enough confidence to show that it can push on at the pace it needs to? Dare?
Yeah, I think there are a lot of activities taking place, but are they sufficient? Are they the right strategy in place? This is the thing that we need to ask the question. If you look at the survey, as you can see, there are more than 60% of the participants, they said they don't have the proper tools, and there is still a segmentation within the financial institutions where the payment solution does not talk with the trade, does not talk with the compliance, and this by itself it creates another challenge to them. So I wouldn't say that there is a focus on trade. Until today, there is 80% of trade finance transactions globally are still paper-based. So, and I totally agree with Andre, the digitalization of communication, the documentation, this is the core things that we need to work on, and having a standards, a language that we all talk the same, this is very important. So this is one thing that we need to, and if you look, Andre, at the people, they invest in compliance. The cost of compliance is increasing. But until today, the focus is on labor rather than technology. So this has to change and to shift minds.
And we'll pick up on that as we go through the rest of the session, because the technology is paramount. And before I come to you, James, I did ask a short while ago for your response to a survey, and thank you for replying in your numbers. Just to remind you, the question was, what's the biggest challenge your institution faces in detecting and preventing trade-based financial crime? And I'll round up the numbers. A lack of awareness or expertise, 29%. Reliance on manual processes, 24%. The difficulty implementing solutions, 9%. Staying ahead of evolving threats is 30%, 29%. No clear central ownership of trade-based financial crime, 4%, and something else sits with 5% of the attendees. So, James, firstly, are you surprised by any of those figures? Does it sort of resonate with you? And then we'll talk about the regulation complexity. James?
I'm not hugely surprised by the poll results. The driving point behind this, and this point that Dare made, is this is really hard. That it's incredibly high volume, incredibly complicated types of transaction, and in huge variety. Staying on top of warehousing fraud presents very different challenges to keeping on top of sanctions evasion. Even though you see similar typologies and methodologies of kind of misrepresentation and essentially deceit, the way that reveals itself and the way it's obfuscated can be very different in practice. And Andre has given a very good overview of kind of where we are in terms of the digitization of trade documents and the enabling legislation that was enacted in the UK last year in order to help facilitate that and supporting actions of the UN. But what we're seeing on kind of the other side of the coin of regulation, which is really where the positive obligations are being imposed on the financial sector. And this is part of a trend that we've seen over the past 10, 20 years on the purely financial side. So perhaps starting with the 2010 Bribery Act and the failure to prevent bribery offence, where really what you saw was positive obligations being imposed on the financial sector, not just to not commit acts of bribery, of financial crime, but to take positive steps to actively prevent others from acting in that way. And while we've seen kind of significant development of that and a large corpus of regulation on the financial side, we're starting to see that catch up now on the trade-based financial crime as well. So the biggest development we've seen over sort of the past couple of years is due to come into force next week. And that is a significant change to the UK trade sanctions regulatory framework. And that's going to see an increasing alignment towards changes that were made on the financial side between kind of 7 years or so ago. Of the big changes we're seeing, there's a new unit being set up called the Office of Trade Sanctions Implementation, which is going to be a new body responsible for monitoring, implementing, enforcing certain elements of trade sanctions. And with that comes new regulations. First of all, there's going to be the ability for civil monetary penalties to be imposed on a strict liability basis for breaches of trade sanctions. So that will mean that essentially the knowledge requirement doesn't need to be demonstrated. So even an inadvertent breach could result in fines of up to £1 million per offence, or 50% of the value of each breach, whichever is higher. But with that is also coming a positive reporting obligation on UK financial institutions. They will be required to report identified breaches of UK trade sanctions to OTC, either committed by themselves or committed by counterparties, third parties with whom the financial institution has dealings. And what that essentially is doing is pushing down the monitoring intelligence function that government might traditionally have had onto the financial sector. The financial institutions will now essentially be required to monitor their trade books, scrutinize, and in the event they do identify potential bad actors, to report that information into government, and failure to do so will equally be potentially punishable by civil monetary penalties. What I would like to say, and what I hope to be able to say, was that this was a harmonization of the approach to trade-based financial crime in UK government. Unfortunately, what's becoming quite clear is that there is an increasingly Byzantine structure that is being created. As I mentioned, OTSI is responsible for some trade sanctions violations, but not all. And the scope of its remit is different when you compare enforcement, where it has essentially responsibility for all trade sanctions other than goods crossing the UK border, or for military goods and dual-use goods, which will continue to sit with HMRC. But that doesn't mirror across to its licensing responsibilities, which will only be in respect of certain service-related prohibitions. And what this means essentially is that reporting lines into government are incredibly fragmented now. Depending on the information which comes across your desk, it could mean reporting into the Treasury, could mean reporting into HMRC, it could mean reporting into different parts of business and trade. And I think this is really going to create practical difficulties in marshalling and collecting the intelligence that's being generated as we move towards AI-based platforms, large language modeling and scrutiny on that side. It's going to produce a large volume of results
Rob,
that then need to be filtered. Sorry, Gary.
No. I just want to come back to a couple of those points, because obviously here we are talking about fragmentation at the lowest level in terms of operations, and now as we try to move forward, we are still talking about fragmentation at government level. So I'll come back to that, but I want to bring you in, Rob. You may have a view on some of the points that James has just said there about the level of overall governance and so on, but I equally want to step back into a conversation around, at the end of the day, as you said so well in your opening remarks, it's the quality of data, it's the accessibility of data, and how do you put that together to start to detect patterns and trends of behavior that lead you to be concerned that they're suspicious, absolutely fraudulent, or legitimate. So from your point of view, how are you seeing the use of data coming together in transaction monitoring of trade-based deals? Rob?
Well, for us, data is key, and Andre and they all both also address the same point. The data for me is key. Digitalization of the data is key. If we look at the typologies that we look at in trade-based money laundering, where you want to look at the networks and at the hidden relationships of your clients, but you also want to look at the anomalies that you see in behavior of the client, and whether that's in the product or in the payments, but also the anomalies in the underlying documentation. And determining anomalies in underlying documentation when it's not digitalized is impossible to do by manual workload. And we look at it from a deal by deal basis, but you cannot expect that someone remembers what this client has done 6 months or 12 months or 3 years ago. And with the underlying AI technology that we are now starting to implement, you can determine that. But then again, you look at it from your own bank basis. You're not looking at the other banks in the payment chain. You're not looking at the other banks in the trade. So we need to start working together as banks to start determining what are the fraudulent companies in this chain. Because one by one, all the payments make sense, but you have to look at it in a network perspective. And for that, the data for me is key. And working together with the other banks is key, or the other institutions in that payment chain.
So, Rob, the phrase that we have in the UK is keep your own house in order, but that doesn't mean to say that everybody else is doing likewise. So how do you tackle this issue of the downstream knowledge or insights that you need to perhaps have more awareness of? It's and particularly against the background of, as I said at the beginning, so much of the data perhaps isn't in electronic form. How do you start to wrestle with those things? Indeed, how have you done that at ING?
So we have open conversations with all the banks that are in our network, right? So we work together, of course, with thousands of banks, but we work together very closely with numerous banks that are also part of this payment chain. And we have an open conversation on the items that we that we fall into. And many of those also make use of advanced analytics or AI tooling, and we address the same issues. And we also want to tackle them together. But like you say, you want to first have your own house in order before you start getting also your neighbor's house in order. But my drive, that's more from a personal point of view, my drive is to make the whole street and all the houses in that street clean them up. So that would be my goal, but it's not easy to do if your own house is still a mess, right? So start with your own house and then start looking at the rest of the street. But that's hard.
It is hard, and there you surely will have some experience of this, because what we are talking about is the data being extensively important here, but it sits in multiple formats, in multiple data points. And if we're going to start picking up on the use of the various branches of the science of AI, that's all got to come together. Are you seeing evidence of that? How do you see that emerging?
Okay, first of all, I
see AI massively emerging.
This is for me, or sorry?
If Dave goes first, then I'll come back to you, Rob, if I may.
Oh, okay, sure. Sorry, Dave. Go ahead.
Apologies. Yeah. So the way we see it, that first of all, the good thing that the financial institution, they acknowledge that having a traditional way to deal with such volume of data is not working anymore. So bringing all these data together is really difficult unless you have tools first to digitize. So first, Gary, we need to digitize everything in order to have a data layer that we can run a sophisticated AI, machine learning, Gen AI tools on top of that. So this is exactly what we have decided to do. What we have done, that we have brought all parties, or all, let's say, the building blocks for trade finance transaction. That includes the documentation, then the payments that is related to trade finance. There is the vessels, there's the goods, there's everything related, and there is the entities, the seller, the buyer, and everyone in the middle. All these entities, we really connected the dots, and we have created a holistic view to look at things in a very holistic manner. So we digitize the documentation using NLP capabilities in order to understand the documents, to convert into structured data that is of a high quality. We inject this data into our systems, then we connect it even with, if there is a SWIFT payment related to it, it will be connected to it. If there is another update, it will be connected to it. So this manner, we have connect everything related to this trade transactions together. Now, when it comes to the controls, we run all possible controls, including the sanction screening, the PEPs, the ports, the sanction ports, sanction cities, dual good use. All this is in continuous, and this is, we don't do it once, because as we said, regulation is very fluid. Today you are not sanctioned, tomorrow you are sanctioned. While the ship in the water, in the middle of the ocean, you might get sanctioned. So you need really to keep monitoring. So there is this nature of, because of the long period of the trade finance transaction, we need really to have a continuous screening, continuous monitoring that really reflects the momentum today, what is happening. In addition to that, we track also the vessels itself. So where did it stop, everything. You cannot analyze or understand this data unless you are using advanced AI machine learning. We learn from behaviors. We can really predict using AI machine learning to really predict if this ship stopped longer in this port, there's something wrong. If it changed the route, there's something wrong. If there is certain cities involved, there's something wrong. So the AI is extremely important because the data that you're collecting from all these parties, it is a huge data and very rich data that you really need to exploit very well.
Yeah, that's very well put. Andre, how do you see that, given your involvement with the banks that you're working with, and the role that AI plays, and this almost constant always on monitoring that now seems to be a necessity. Andre?
Yeah, I would definitely come back to this idea of digitizing internal processes, which banks can achieve quite and have started years ago and continue to enrich in order indeed to have a continuous monitoring of their own operations, because the operations need to be monitored technically and from a pure operational perspective, then business-wise and from a compliance as well. So internally, they can proceed with a mix of various technologies to achieve what they want to achieve at institutional level and what the regulators are asking them to achieve. And then we have those industry ambitions around indeed digitizing the communication with counterparties. And this is where trade finance is very specific, because we are not just exchanging data, we are exchanging value. A bill of lading is a title document. A bill of exchange is a payment instrument. It has value. It's very different from payments and cash management, where we only exchange information, not value. And this is where we have to change those laws. So I think the regulators understand also, because of the cases, the fraud cases we had, take Singapore, the regulators understand the value of digitizing also the communications part between institutions, because once you digitize data, you can measure, you can monitor at industry level, at country level, but you can also add value, such as additional monitoring capabilities at business level, such as protecting against double funding fraud. When one instrument, one bill of lading is funded with multiple lenders, this is fraud, but it's hard to achieve unless the whole country, in Singapore in this case, is moving on to a digital process. Doesn't mean we have to centralize everything on a single platform, but the whole market has to be digitized in order to check that a particular instrument hasn't been financed yet. So, and regulators are on that kind of value add.
Let me pick up on that with James. Are the regulators onto that? And also, I suppose the other point, picking up on your previous comments, I mean, we're looking at, if I summarize it, a load of sort of reasonable risk-based controls that we're trying to introduce into the level of monitoring and the way that the business is managed in the trade world. But how does this really start to play out on a more global scale? Because you'll have willing jurisdictions and unwilling jurisdictions in order to try and pick up on some of the points that Dea and Andre have touched on there. This global regulatory complexity is hard to achieve. And how is that panning out? What's the landscape going to look like, James?
So I think it's that key point that Andre made, is that we need entire market buy-in for this essentially to be successful. We've seen a whole range of kind of typologies, ranging from the very sophisticated through to the very unsophisticated. I think the most egregious we've ever seen was a suitcase full of bricks that have been spray painted gold that someone was trying to pass off. But equally, we see vessels with AIS data being falsified that requires satellite imagery or human intelligence to be able to pick up on, or large-scale analytics to be able to pick up discrepancies in voyage movements. But where there are weaknesses in the armor are largely, I think, blind spots for many of the regulators. If you look at the guidance that's come out over the past year or so, for example, there is a kind of over-focus perhaps on certificates of origin, saying, well, if you've got a certificate of origin that says your oil is Kazakhstani, that's good enough. When in actual fact, a certificate of origin is no more than a sheet of paper with a stamp from a local chamber of commerce, which can be very hard to identify, to verify the accuracy and legitimacy of that document, particularly once it's come through 5, 6, 7 layers where that cargo has been bought and sold while it's in transit. So unless we can get to a point where there is an integrity of documentation across that entire value chain, then I think it's going to be very difficult. And I do think there is a bit of an overemphasis placed on the existing documentation that we have by the regulators and the existing information that we have. So a couple of years ago, there was a maritime advisory that was put out by OFAC, by State Department, the US Coast Guard, which talked about AIS data and vessels GPS broadcasting as essentially the panacea, and basically saying, if this is ever turned off, something has gone wrong. And that isn't reflective of the real world situation. There are AIS black spots, hostile states use AIS jammers. There are a multitude of reasons why a vessel may not be broadcasting AIS, which doesn't necessarily mean they are bad actors. And that's why we need sophisticated analytics that help screen and parse the information that is available, and to rule out, I was intrigued by Rob's comment earlier of 99.9% false positives, screening that out, because otherwise you can't spend the resource, the finite human resource you have to scrutinize that 0.01% of cases that need that genuine review.
So let me come to you, Rob. There's two questions, really. You may have a comment on what James just said there, because obviously you're looking at the monitoring. But if we talk about things happening on a global scale through the regulation, we also have to talk about things happening on a global scale through the industry. So are you aware of, who's sort of the best place to drive some of these things at an industry level, not just the regulators, but is it SWIFT, it is other bodies that are out there? Who could take that from a practical, procedural, operational point of view and push this forward to the level it needs to be at from an operations perspective? Rob?
Yeah, I think you addressed a couple of points have already been addressed. I think regulatory, it would help if we are forcing the companies to make use of documents digitalized, right? That data for me, and I was a bit surprised with the outcome of the poll. Data for me is the key point that we need to start with to get that data right. SWIFT already made massive steps in providing structured data, providing an end-to-end reference on an underlying payment. So we see that SWIFT is making, or is in the process of making, the steps towards providing us data that is there in a structured way. The ISO format is a good example. From MT to MX, we have more fields available, more data available. So it gets easier for us to get the structured data into a transaction monitoring system. So we see that it's not only SWIFT, but it's also the regulators that have to step in here and say, okay, but you need to digitalize the data, and then we can get it structured, and then we can start monitoring against it. Because like James also indicated, if we have a document with a bill of lading with a stamp from the Chamber of Commerce in Kazakhstan, it's easy to falsify, right? I mean, it's not that hard, and then transaction monitoring makes no sense at all. And then to come back, indeed, that with the rule-based systems we see, not only in trade, but across the industries and across the sectors, that there's a false positive rate of approximately 99%. But now with AI and with advanced analytics, we're getting to a false positive rate of about 80%, so 80. Which means that we have true positives of almost 20%, which makes a massive difference in the transaction monitoring world. And we need to step that further up to get to 30, 40, 50%. But getting that structured data, being forced by regulators and working together with the other financial institutions in the world are, for me, the key drivers to get that data at the quality that we want to be.
Thanks, Rob. And Andre, a final word. Collaboration is clearly key here. So how do you see that is best achieved? Is it still with someone like SWIFT or other bodies coming together? It seems quite a lot of fractured way in which is looking this issue is being looked at. Maybe I'm challenging the global way in which it can start to be looked at from a business perspective. Andre.
I agree with Rob that if we have a regulatory obligation, things become much easier for banks to justify the effort and the investment in additional technology. And that's where compliance scores, at least when we listen to our members, the ITFA members, the banks mainly, but also credit insurers, telling us compliance and fraud protection is #1 priority. So then how to achieve it? I don't think we can rely on a single provider, single institution to provide some magic into this. There will be a mix of technologies, and we see it now with the digitization of bills of lading, a mix of associations as well, because bills of lading are coming from logistics world. This is not a banking document, a banking instrument like the bill of exchange or the prom note or the payment itself. So we need a mix, and this is where indeed some associations like DCSA, based in the Netherlands, focusing on digitization of bills of lading for the container, have the opportunity to become an authority to drive market adoption, to show the best practices coming from logistics, and that will benefit the banks because those documents are so important. So it's always a mix of technologies, a mix of associations, and they change depending on the use case, because trade finance has a lot of different instruments. Some are starting or generated by banks themselves, others by corporates, others by logistics companies. So it's not just one use case, like we know from the payments and the cash management case.
Yeah, thanks, Andre. It's well summarized, really. It is a much more complex and perhaps untouched business over time. Listen, we are coming to the end of what I think has been a great, insightful conversation. I'd like to thank Andre, Rob, James, Dea for your preparation and your contribution. I hope that you've enjoyed joining us today for the conversation. The report is still there for you to download, and if I kind of think through what we've been talking about today, there seems to be, firstly, a huge need to bring the business into the modern world with more modern techniques, digitization, and so on, and maybe eliminate the fragmentation that exists there. I also think that ownership and leadership is key across the industry to drive these things forward. And of course, technology and the use of artificial intelligence is paramount. But Dea, you started off by saying, we've got to stop being reactive. We've got to start being proactive and planning ahead. So maybe over to you for the final word, Dea.
Yeah, thank you, Andre. Thank you, everyone. So I just want to comment on one thing first regarding SWIFT as being the answer. SWIFT, what they are trying to do, they are trying to connect all parties together. So they are trying to connect to trade platform, to the ICC, to different players. But we have to really to be aware that SWIFT is very much a biased tool, because if you look at it, who's putting the regulation, it is more of a Western US control. So we are ignoring the rest of the world if you really look at it, and this is the answer to everything. So we have to be very much aware and mindful to that. My final close to this is regarding the title, the global when payment meet trade. Actually, what we are noticing recently that the payment, the payments has fundamental impact in international trade. So we have to really be aware that people are really adapting to the digital payments and now to the real payments, and they contribute another risk to the trade finance. Even FATF and WEF, they have highlighted that the increasing risk of trade-based financial crime, that there is an increasing risk because of the volumes expand via digital payments. So we have to be aware that adopting another digital, we have to be on the same page. You cannot really have something which is real-time payments while your systems are slow, not real-time, not adaptive, not predictive for all the risks that you have around us. So this is very important. Again, this is to confirm on being proactive, If you want to really to have full digitalization, including the digital payments, you have to be ready and connect the payments with compliance with trade. And this is only where you can be ready to really face this challenge. Again, for me, the challenge is clear: avoid the risk and you miss the opportunity. If you want
Thank
really
you,
to, that's the final word to me.
That's a great note to end on. It's what we said. Let's not overlook the opportunity that exists in this business. At the same time, let's help the good actors do what they do well and the bad actors to stop doing what they do. So on that note, I thank you again for your participation in the poll question, the questions you shared, and obviously for joining us throughout the whole session. So thank you again to the panel. Thank you again to you. And I'm going to close off the session now, and do enjoy the rest of your day. Thank you for joining.